Let's move on now to retirement funds. You will remember that there were major amendments concerning the retirement fund regime, which came into effect on the 1st of March 2016. There have been a lot of unintended consequences to this legislation. There are a lot of refinements that are needed, and the discussion is ongoing. So for the next few years, we're going to see small little technical amendments dealing with retirement funds. The first one that we'll have a look at here is transferring retirement fund benefits after reaching normal retirement date. Now, normal retirement date doesn't really feature for tax purposes anymore. You don't have to go into getting an annuity on the day that you retire. They're actually wanting you to preserve your retirement benefits and only draw on them as late as possible in life. So you don't have to accept an annuity on the day of the fund. They're trying to provide a little bit of flexibility in that regard. So what they're doing now is that there's been a proposal which says you can go ahead in terms of TLAB and say all employees are allowed to transfer their benefits to a retirement annuity fund for later consumption. So that's going along with the idea that we're saying keep your hands off the funds for long as possible. Transfers to preservation funds are not currently included in this preservation, since it could result in the withdrawal of all benefits in the form of a lump sum. So now we come back to this debate about preservation of benefits that was supposed to be applied to provident funds from 1 March 2016. This was delayed. So what people are seeking to do is to take funds, transfer them into preservation funds, and thereby be able to access all their capital at retirement date and avoid annuitization. Obviously, National Treasury is not very keen on that. So now it is proposed that there will be amendments that will allow for transfers after retirement to preservation funds and to provident preservation funds. This amendment will make sure that only provident preservation funds can later be withdrawn in full. If you have pension preservation benefits, then the usual 2/3, 1/3 commutation rule will still apply. Right, now go on and say, well, what happens with tax incentives and retirement funds? Retirement funds enjoy enormous tax incentives. The bulk of the 50 billion rand tax incentives that are given to personal income tax in South Africa. That's 1/3 of the total tax incentives in South Africa. Corporate tax incentives are small. VAT is predominantly given in the form of benefits for the poor, and customs and excise duties concessions mainly affect the motor industry. So we've got to say if there's an incentive to be had in tax, it is around retirement funds. That's where the money is. So if we take that and we say, right, we go back to 1 March 2016 and we see the new rules that come in on contributions. That is basically that you are allowed to contribute 27.5% of taxable income to a maximum of 350,000 Rand per annum. That gives rise to a very generous tax incentive. Now they're saying that must be strictly and properly regulated. Now, when one looks at investment in retirement funds in the new order, what we're saying is there is a very generous benefit on contribution. That is then topped up further by a complete tax exemption from both income tax on the growth of the fund, dividend tax, CGT, and even interest is exempt within the fund. If you want, retirement funds have become the new little tax haven. And there are other added benefits such as your death benefits, which are estate duty free. Now, if one looks at what we're trying to achieve in a retirement strategy today, we say take the various qualities of income that you will receive after you stop working. Take the various types of income that you're going to receive in retirement. Remember that you have stopped receiving the principal form of taxable income, which was your salary. You then have, in your retirement, you have your shares, you have your unit trusts, you have your insurance policies, and finally you have your retirement funds. Now look at the quality of income coming from each type of investment. And you see there is CGT payable at vastly reduced rates on both the disposal of shares and unit trusts. Your insurance policy is drawn down tax exempt because it has been taxed within the fund. The problem is your retirement fund, which is fully taxable if drawn down by way of an annuity. So the obvious solution that we're looking for, and is indeed catered for in the legislation now, is to say, I want to draw down my retirement funds as late as possible in my life, because I'm wanting to defer the fully taxable portion of my investments when they are sold. This must be coupled with the change in the taxpayer when they reach the age of 65, where you suddenly get a range of benefits. You get the geriatric rebates, you get interest rebates, you get CGT deductions. You also get the medical credit unlimited and at a rate of 33%. If all of these are coupled together, it is possible to vastly reduce the actual tax that will be paid on a retirement fund benefit. Because what have you got? You've got the retirement fund, which can be managed today by saying, right, on the living annuity principle, we can take a component, which although gross income is not particularly going to hurt you because you are in the lower marginal rates of tax. You can also neutralize some of the tax on your retirement fund through your medical expenses. They are your highest expenses in retirement. And then, of course, there is the second schedule benefit. Now, the second schedule benefit is what everybody used to go for. But you're going to have a look at that today and you're going to say, you know, it's changed. The second benefit schedules have not kept up with inflation. There's an element of fiscal drag in that. So yes, it's nice to have 500,000 Rand tax-free in your retirement, but it's not going to keep you going for the rest of your life. Maybe drawing up to 700,000, that's okay. There's only an 18% tax rate on it. But you have to admit that by taking a lump sum of more than 700,000 and paying possibly 27% tax or even 36% tax, that's a vast slug of tax to pay in advance. So when one has to say the second schedule is not what it used to be, what we're actually looking to do is to defer and leave the funds invested in the sanctuary of the retirement fund. So you take these tax incentives and you say that personal tax incentive is a very valuable incentive. You're not going to pay it all back in retirement, because by managing your funds properly in retirement and deferring the actual tax, you will pay back a lot less. Right, so we move on from there and we say, what else has changed in retirement funds? Next comes up is the treatment of the special benefits that we got on public sector funds that were accumulated prior to 1998. You will remember that the benefits from public sector funds were tax exempt pre-1998. Now, and they've said even if you moved away from a public sector fund towards another fund, it would retain its identity as being tax-free. Now, the proposals were to say, right, in building up such a fund, you could move out of a public sector fund towards another fund, and your funds would retain their tax-exempt status. What has been called for is that you are now allowed to retain that identity of tax-exempt funds and move continually from one fund to another fund, from a pension fund to a retirement fund, etc., without disturbing the tax-exempt status. What they've said on that is no, you are only allowed to move it once to one other fund. The moment that you move tax-exempt funds to further funds, it will lose its identity. Finally, there has been a 12-month limitation period from moving funds from one fund to another fund, and that has been withdrawn. Finally, one needs to look at the 12-month limitation period on joining newly established pension or provident funds. In the past, there was a 12-month limitation to switch from one fund to another fund. That limitation has now been withdrawn. And then finally, we look at deductions in respect of contributions to retirement funds, Section 11 Cap F. Now, there has been a lot of confusion around the calculation of the tax-deductible 27.5% contribution to retirement funds. And this has been clarified in this new Section 11F. And what they are saying is they're looking to provide clarity. And in the explanatory memorandum, they make it absolutely clear now that this is not a means of allowing a higher deduction. The overall policy has remained the same. What the legislation now provides is that this new provision helps you in calculating the maximum permissible contribution. However, the principle remains the same. You cannot contribute a portion of your capital gains, tax deductible, to retirement funds. Finally, there is the ongoing and thorny issue about annuitization of provident funds. You will remember that the idea was that this would come in from 1 March 2016, and all subsequent growth in provident funds would be subject to annuitization. Well, that didn't happen. Primarily, what happened was that organized labor said, you're not going to fiddle with our funds. And so Pravin Gordhan, the finance minister at the time, he had to bow down on that one. But, you know, politicians don't just scrap something, they always postpone it and leave it for somebody else to do. So the postponement has happened, and it has now been extended to 1 March 2019. Let's look at tax incentives in the SME sector. There's a small little change there. You will remember that the SME sector is favored because in the National Development Plan, much is expected of the SME sector in achieving the objectives for 2030. So, what we have is a range of corporate tax incentives that only amounts to 5 billion rand in South Africa today. The Davis Tax Committee is currently looking at justifying a higher level of tax incentives for corporates. But let's look at what these are. There is the Small Business Corporation, which costs government about 2.2 billion rand a year. The Davis Tax Committee has now made 2 reports on this. They've said this is not the way to go, you should think again, but nothing's happened. The Research and Development Allowance, the Learnership Allowances, etc., their utilization is pretty small. But then we get to the Employment Tax Incentive. You will remember that that is what we call the Youth Employment Subsidy sometimes. Well, basically, that's a massive subsidy costing 2.4 billion rand per year. It's been extended till 2019, and the reason is that the research that was promised to look at the effectiveness of ETI has not come through, so they've just extended it. At the moment, one has to question how well these incentives are serving South Africa, but the more research is to come on that later. In the Davis Tax Committee, they looked at 3 levels of doing business in South Africa. There are the formal sector, which are mainly corporates, with your 28% tax headline rate. Then you have the missing middle, or the entrepreneurs. They are supposed to be using up the Small Business Corporation allowances, and then at the bottom of the pie, you have survivalist business, which needs the maximum level of efficiency and the minimum level of disturbance in their tax affairs. So the idea is to have the sixth schedule of the Income Tax Act, the turnover tax as we call it, that provides for survivalist business. The problem, of course, with it is that survivalist business doesn't even bother to register. The amendment that you get goes along with climbing up the ladder of growth in SMEs. So there you have the micro business schedule, which of course is capped off at 1 million rands turnover per annum. But at the beginning of a year of assessment, you don't know if you're going to do more than 1 million or not. So during the course of a tax year, you might migrate from being a survivalist micro business to an SPC. And if you jump up into those categories, you could suddenly face a tax liability that you didn't anticipate at the beginning of the year. Now that's bad enough, but if you suddenly have a penalty in terms of the Tax Administration Act because you've stepped up in growth and you've had to change regime, well, that's going to be counterproductive. We don't want to stamp on people who have suddenly become successful. So what the new amendment is all about in Section 48C of the Tax Administration Act is quite simply to say, if you migrate from the turnover tax system to the SPC system, then there will be no penalties for your success in terms of the Tax Administration Act. So let's have a look at it. We are saying, where are we in the total tax pie? Increases in personal tax will not be enough to solve South Africa's problems. The new tax amendments won't be enough. Corporate tax and dividend tax can't really be increased in South Africa without having adverse effects on the economy and international investment. So now what we've got to look at is other forms of taxation which will have to be considered if there is going to be any inroad into South Africa's massive fiscal deficit. So let's look at other tax alternatives, what could happen, what can be done. And of course, there's always that issue of raising the VAT rate. Now, raising the VAT rate, for years I've bet it wouldn't happen, simply because it's politically unacceptable in South Africa. The unions have drawn a line in the sand and said, no ways. However, the economists have looked at it and said it is the least damaging effect of all the taxes is to increase the VAT rate. But the Davis Tax Committee, when they looked at this, immediately made a caveat to that, which they said, never lose sight of the fact that you are going to have an adverse impact on the poor. And they said, if we are going to do something about this, what we have to do is to plow back a lot of the VAT, additional VAT that is recovered from an increase into targeted interventions for the poor. Organized labor freaked out just at that suggestion. But now we've come to a point when you're looking for 50 billion rand or more a year. The only place you're really going to find it is within the VAT system. So if there is some magic in the new Minister of Finance, if he can come to an agreement with organized labor, well, then we are making progress. Now, suddenly in the rumor mongering that is going on at the moment is a suggestion that South Africa will move to a dual rate system in the future. This seems to be a suggestion that's gone directly to Cabinet, not through National Treasury or the Davis Tax Committee or anything else. The Davis Tax Committee has looked at a dual rate system, and we didn't favor it. We've said, if you are looking to get more tax from, say, luxuries, well, then you have a sin tax on it. And then the beauty of that is that the VAT is added to the sin tax, as you have with cigarettes and alcohol. Having differential VAT rates just causes chaos. But in the desperation to find a higher source of revenue from VAT, dual rates are now being discussed. Zero rating has, for a long time, been seen as a way that we can compensate the poor for an increase in the VAT rate. The findings of the Davis Tax Committee are that the zero rating system for the poor is a very blunt instrument. And we've even got a graph there which was developed which shows that a huge proportion of the zero rating benefit is enjoyed by the top income deciles of South Africa. So we cannot compensate for a VAT increase by increasing the general basket of tax-exempt goods and services. So in conclusion, we are saying the Minister of Finance has to look at this and has to bite the bullet. Either go for a VAT increase and compensate the poor by way of targeted interventions, or they've got to have a look at a dual rate system. But next year will be the first time that I'm actually saying a VAT increase is possible. That is the extent of South Africa's problems at present. Then we must also look at fuel. Now, in the fuel category, we've got to say Pravin Gordhan was very light-handed on fuel tax increases. He tried to avoid them at all costs. But there is an announcement in the budget review from February that National Treasury was going to look at the removal of the zero rating of fuel. So that what that would lead to is a VAT charge in addition to a fuel levy. Now that would raise an awful lot of money. But you've got to remember that all is not well on the fuel front at the moment. What we have seen is over the course of 2016, oil prices have been recovering at a very fast rate, and we're now well above the $60 per barrel mark. When you put that together and see other forms of fuel, for example, maize, that price came right down at the beginning of 2016, but it started to creep up again. And then also remember that the South African exchange rate against the US dollar has showed quite considerable weakening in the last few weeks. So it is not going to be very easy for the Minister of Finance to seek to get a massive amount of additional tax from fuel. They're going to have to look somewhere else, we hope. Of course, the booze and the cigarettes will go up in next year's budget, but it's not going to solve the problem. The sin taxes on alcohol and tobacco have been increasing at about 8% per annum, which is above the inflation rate. And it does get an extra 2 or 3 billion rand per annum. But it's not going to solve the problems for Mr. Gigaba. It's simply not enough. We can't smoke and drink South Africa better. So they've got to look for other forms of taxation. And this is where the introduction of sugar-sweetened beverage tax is scheduled for next year. They're saying, well, we know that sugar is killing everybody, so let's put a tax on sugar-sweetened beverages. They're aiming to get about 1 billion rand out of it. Sugar tax is trending the world over, but it's not solving the overall problem. If you look at the Mexican experiment, where they had a sugar tax much higher than South Africa's rate, and the tax was recycled into the problems associated with sugar and education about it, then they achieved something. But whether a very mild sugar tax will do anything more than score a couple of billion, maybe, it's just not going to do it for them. Transfer duty continues to do its ugly work as property prices slowly go upwards and the schedule is amended. All that they've done recently is to increase the lowest rung to 900,000, and that demonstrates the real beauty of, amendment, and that demonstrates the problem with transfer duty. We're now seeing greater volatility at the lower end of the property market. Why? Because there's no tax involved. However, at the top end of the market, there's a different thing happening. There, we're getting stagnation in the property market due to transfer duty of up to 13%. If that is added to the CGT on sale of your old property, moving costs, legal costs, the honey-do list, etc., 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 it is stagnating the property market, and it is universally agreed almost that transfer duty is a lousy form of taxation. It's just that South Africa can't get rid of it at the moment. We can't afford it. So transfer duty will continue. They'll have to look elsewhere. So they go to carbon tax. Now, carbon tax was looked at by the Davis Tax Committee in 2015, and some severe reservations were made about carbon tax implementation in South Africa at a time where South Africa's growth rates were diminishing. And consequently, it was put on the back burner by Pravin Gordhan. Now what we see 2 years later is that the situation is so desperate that carbon tax implementation is now back scheduled for 2018 or 2019. It's not very likely that they will get the legislation through by the start of the next tax year in April 2018, probably 2019. But they're having to look at other forms of taxation now because South Africa's tax base is just not big enough. Then comes the issue of wealth taxation. So let's say, what wealth taxes do we have in South Africa? That's predominantly transfer duty that we've spoken about, and estate duty and donations tax, which score very little for government. Now comes the task of the Davis Tax Committee to look into wealth taxes. We've been working on that all year, the various types of wealth taxes, and a report is going to be forthcoming probably by early next year. There have been various suggestions made to the effect that before we get into the complexities of wealth taxation, and it will take us years to implement it, perhaps we would do better by properly exploiting estate duty, closing down the loopholes, better administration. All of that has been in 2 reports of the Davis Tax Committee, and SARS has given the assurance that in the growth of their high net worth individuals department, they will be doing more to make sure that the existing wealth taxes are properly implemented. So in wealth tax, what one can expect in the short term is a tightening up of the administration of estate duty and donations tax, increased examination of the estate files of the high net worth individual. In the long term, well, we could see amendments to the Estate Duty Act as proposed by the Davis Tax Committee, but then one could also look at what is going to happen with the wealth tax. The biggest issue with the wealth tax in South Africa is that unless you are going to apply the wealth tax to retirement funds, it's going to yield almost negligible results. And when one gets to the taxation of retirement funds, of course, organized labor are going to say, hands off our stash. So there's a big debate there. The final aspect of wealth tax is whether we should be looking at a land tax. There is technically an argument for further land taxation in South Africa, but this was looked at by the 8th report of the Katz Commission 20 years ago. And they said the prerogative for the taxation of land must go to local government. So what are we going to say now? We have local government taxes and we have taxes at national level? Maybe not. Other Davis Tax Committee reports that have been published, there is the second and final report on base erosion and profit shifting. There is the second and final report on hard rock mining. And then there is the oil and gas report, which has been written in conjunction with the IMF report on the same topic. These are very specialist areas. I'm simply mentioning that these reports are now available on the Davis Tax Committee website. So that's my economic update. It's tough times, and we've got to say that the national budget speech on the 21st of February 2018 is going to be the mother of all budget speeches. So sit up and pay attention. I'm Matthew Lester. Thanks for your attention.